Hello, hello. Can you guys hear me? Nice to see everyone today.
GM.
Yeah, see you loud and clear.
Awesome, awesome. Who am I joined with today? We can start with you, Iggy. Could you please give a quick introduction to yourself?
I also do a quick intro, but I worked, I kind of have a long career. So half Silicon Valley, half Wall Street. I started in private equity, try to make it quick at Bain Capital. Then I went to Harvard Business School, started a software company there, moved to Bay Area. Ultimately, we grew to 300 people, sold it. Then I worked in hedge funds covering tech, ultimately ran prop trading at Credit Suisse in the US and Asia, started my own hedge fund that was seeded by Blackstone. Then I ran Polygon Ventures, and through that, I met the founding team of Theo. Initially invested, and then once it started to get a product market fit, I jumped in to help them scale.
Amazing, amazing. Very, very detailed background with a lot of experience. So I'm sure the wisdom is gonna be very useful for this stream today and making sure that the audience can learn a thing or two from all of your experience across the board. Thomas would like to pass the mic over to you. Would love a quick introduction.
Yeah, sure. I'm Atomist, co-founder of Castle Labs. We're a research advisory firm. Been in the space ourselves about 4 years now, servicing, advising teams, writing a lot of research across ecosystems. Previously, I'm a chemical engineer by trade before coming into crypto. As a speculator, then as an analyst, working in marketing and growth roles, and now, leading this research firm.
Awesome, awesome. Cool. Two very different backgrounds and two very different perspectives to discuss the most important topic in crypto or blockchain, in my opinion, which is stablecoins and how they're becoming an everyday asset. Thank you to both of you for joining us today. I know you guys must be very busy and with everything that's going on with your lives. So thank you for spending some time to discuss with us today. We'd love to first begin with you, Iggy. Just give a quick introduction of Theo before we go into the agenda, just so we understand a bit more about what you guys are building, and we have that context so that we can bring it towards the stream and for the audience to understand as well.
So I think Theo's kind of a mission is to bring all the major asset classes from real world assets on chain, and then sort of not stop there, but actually make them fully usable on chain. So composable in DeFi, make liquid markets for them, enable other people to build liquid markets for them. And of course, the most obvious benefit of kind of on chain is that make them accessible in 200 countries with no minimum, no unnecessary paperwork, self custody. You can have it in your wallet, so that a farmer in Thailand with only a few dollars to invest can start building for retirement, start building for take care of aging parents, and sort of all the fancy things that we take for granted in the West to make it, because blockchain is so cheap and fast and self-service, make all the sort of high-touch things available everywhere in the world. And it's powered by real-world assets, which we started with money market fund on chain, then we'll launch gold on chain, the first gold that actually pays you, that actually has a yield rather than costing you something to store and protect it. And then now, like, our sort of flagship product to this THUSD, which is a synthetic dollar that actually pays you a yield that's higher than T-bills. We can get into the mechanics of how we do it, but it's sort of a combination of TradFi strategies. The general idea is that the yields on chain have come down a lot, as we all know. So in order to scale to the next level, we have to find scalable sources of yield in the real world that can scale, 2, 3, 4 order of magnitude more than the on-chain world, and then make them available on chain.
Amazing. Thank you for the context on everything that's being built at TIA and the different use cases and audience segments that can be targeted. And that leads me into the first question of today, which is, where do you guys see stablecoins being used at the moment outside of crypto trading? Where do you see that sort of going in the next 6 to 12 months or maybe longer? I'll start with you first, Thomas.
Yeah, definitely. I think a lot will depend on what happens with the Clarity redraft that's coming in the end of the month, and how we can potentially attach yields to some of these stable coins. I think probably a lot of the big players in the space are waiting to see what happens here and to see whether they can really have their own yield bearing stablecoins, or whether they need to pass off that yield somehow into other platforms or distribution partners. But really, I guess everyone's waiting to see what are the next RWAs coming in to back some of these stablecoins outside of T-bills, really. People are waiting to see what comes next, and kind of interested to see more than just this vanilla product we have so far, really.
Anything that you would like to add to that, Iggy, for your perspective on where you see stablecoins going over the next 6 to 12 months?
Yeah, so stable coins obviously is like 320 billion now, which is pretty sizable. If you look at the trading volume, it's like 50 trillion, right? A lot of that is bots and wash trading. If you back out of it, there is, I think, 10 trillion, something like that. And then the most accurate number is there's, I think, 390 billion, something like 300 to 400 billion of true actual payments, right? So this is excluding even trading. Trading shouldn't necessarily be excluded, because, again, as long as it's legitimate trading, that's still a use case. But for pure payments, I think it's like 60% B2B payments, 40% consumer. It's all growing 60-70% a year. So that's one avenue by which stablecoins will grow. And then payment trading is another use case. So what's happened in recent months is the stablecoin growth has sort of plateaued a little bit. And a lot of that is because Bitcoin and the crypto assets have plateaued. One of the drivers of stablecoins, if Bitcoin goes up and Bitcoin trading activity goes up, then as a byproduct, when you're not in Bitcoin or ETH and Solana and all the other things, then your idle balances will also be higher, just by necessity. So the more Bitcoin is worth, the more stablecoin are worth. Now, having said that, stablecoins have grown and will continue to grow faster as a percent of the crypto market cap. So the second reason, so that's outside of our control, right? Bitcoin price will, it might be eventually go up, but I don't know. Not financial advice. I can't predict the future. But what's within our control is to provide higher yield for sort of, again, whether they call it stable coins or sort of some kind of a financial asset, synthetic dollar, or even just a yield token, right? Because obviously, like, if it gives a yield, then it's not necessarily stable coin, strictly speaking, by Genius Act compliant, which we are not, by the way. So we are not trying to be a Genius Act compliant payment stable coin. Our use case is specifically investment, and so that the idle. So in the case of trading, it's the idle cash or the cash in between trades. In the case of payments, it's again when you're not sending payments, or somebody sends you payments, where do you keep it? And then overall, just global access to investment and good sources of yield. So the two drivers, just to go back to that framework by which stablecoins will continue to grow. One is, the more bullish sentiment in the crypto market. That's outside of our control. The second one is providing higher yields. So on chain, the yield is super low. The first step was to put money market funds on chain. For now, obviously we used to be 5.5%. Now it's 3.65%. It's still actually a little bit higher, because what happened in on-chain lending, it is so favorable to lenders right now, which is great, right? So the lenders take minimal risk. The protocols are very mature. It's severely over collateralized, fast liquidation, all this stuff. It basically became riskless, which is why the yields have come down. So money market funds, the 4-week T-bill is actually a little bit higher than the truly riskless on-chain lending rate. The risk-free rate is higher in TradFi. And then so providing high yield, which is where THUSD come in, we think could be like a big factor for the industry in order to take it sort of to the next stage of growth.
Yeah, both of you guys touched on the aspect and the importance of yield when it comes to stablecoins, almost as potentially the most important aspect. And then the second part being the industry is maturing, specifically the lending industry. Everything is, the risk levels are going down for users. So that leads me into the next talking point, which I wanted to go over, which is what does stablecoin infrastructure still need to solve, right? We discussed that the main yield source on chain is going down in terms of the overall percentage. Most yield is coming from treasury bills. What are you guys' thoughts on what needs to be solved next? There's been a lot of progress that's been made over the past couple of years, whether that is security, whether that is counterparty risk, et cetera, et cetera. So we'd love to get some of your guys' thoughts on that.
Yeah, sure. I think on my side, I think transparency and, as you said, like counterparty risk is really important as we start bringing in more like TradFi and real asset backing of some of these things. This kind of extends into what we're seeing with the utilization and expansion of vaults at the moment, but often we're not super sure what's happening behind those vaults or behind these tokens. So what's backing them and what risk users who are chasing these yields taking on. I would say that's the transparency angle I think is most important.
Yeah, I mean, I can definitely comment on that as well. So I think, again, so providing higher yield with good liquidity, right? So there's obviously, like, if you're willing to lock up your capital for longer, then you can naturally get higher yield. So I think the sweet spot on chain is to have good liquidity. So some portion instant, some portion, 4 weeks, and maybe, 2 to 3 months out. That's kind of where the market sentiment is right now. And providing yield that is certainly higher than like the money market fund rate, and ideally higher than like borrow rate on the major lending platforms. So let's say above 5 or 6%. So that way people can also do looping if they choose to do so, and then get really nice, double-digit yield. So transparency, I completely agree. So actually, maybe that's a good kind of a chance to explain THUSD. So THUSD, which is the thing we launched recently, is powered by our own TH Gold, which we launched previously. TH Gold is a gold-denominated loan. So we buy gold. There's a few partners that we work with, like Standard Chartered, a bank, and Libera, which is their tokenization subsidiary, and it's a fund administration, a few other TradFi players who do custody and things of that nature. But basically, we'll buy gold, we'll lend it out to jewelers and other industry operators that actually need gold to run their business. So starting with the largest jeweler in Southeast Asia, and then they pay us interest also in gold. So that effectively means that TH Gold is Delta One long gold, one for one. And then the interest that the jeweler pays that minus the cost that's passed on to the investors in TH Gold, or the holders of that token. So prior to TH Gold, you always had to pay. Throughout human history, for people started using gold 6,600 years ago as a store of value and medium of exchange, and it always cost you something to store it. You had to have security. You hide it under your mattress. You're risking your life. To transport it, you need security guards to divide it up. There's a process to melt it back together, to test it. Every little step using gold had a little bit of cost associated with it. So when we launched gold, we wanted to see, hey, how can we, at the minimum, offset those costs? And then we realized that by leasing out gold, and it's very low risk because we maintain title to the gold in this case, just because it's not a loan to this business, it's a lease. So if something happens, we still own the gold. They're just same way you lease a car, right? So when the car dealer leases to you the car, they still own it. You just use it. So similarly, there's a kind of event. It's like it's bankruptcy remote. So that's in the spirit of transparency, I think it's good to explain where the yield comes from. So that's TH Gold. Then what we add with THUSD is we go delta -1 by shorting gold futures right now on the CME. And gold futures are always in contango, so you can harvest the roll yield, which is typically around the risk-free rate. Right now, it's actually even above 4%. So when you short the futures, contango means the future price is higher than the spot price, and then as the time goes forward, the future price comes down to the spot, assuming nothing happens fundamentally. If something happens fundamentally with gold, the whole curve will move. So that way, we end up with a stable coin, basically. So it's no longer THUSD, it's no longer long gold, but it's backed by gold, and it can give you yield. So with the back testing that we've done so far, it is resulted in sort of 8.1, 8.2% yield. And this is the sum, again, just summarize, it's the sum of the gold leasing plus shorting gold futures on the CME. So there is not, and there is, the only risk that there is that the yield could be a little bit less, right? So let's say if the curve, there was a run on physical gold a couple of months ago, and then the spot price of gold really increased, so the contango was very low briefly, and then you could only get like 2.5% by harvesting the roll yield. So the risk there is that you get slightly lower yield, but there is really not a lot of risk in terms of the whole thing falling apart, because it's all, we work with sort of blue chip players on both sides. And the other beautiful thing in RWA, right, even if the protocol gets hacked somehow, you can just cancel the tokens and reissue them, similar to like what Tether has been doing, and of course Circle has been always been doing that. So you can't really steal RWA tokens the way you can steal like Bitcoin.
Yep, exactly. And I think it's really interesting in terms of like the role of how stable coins and like the real world assets fit together to create real verifiable yield, so that users have that trust component and are basically able to understand that, hey, it's not just treasury bills that are being used on the back end, but there is a real flow of yield that is dynamic depending on the real world price of gold and sort of the curve that may exist between the future and the spot price. So I think what you guys are doing at Theo is really interesting on that side of things. And I think just kind of going to one of the talking points which I prepared before the call is just there's a number of different ways of how tokenized real world assets and stablecoins can flow and fit together. So you mentioned one is specific use case of how Theo is doing it with gold. So Thomas, any thoughts on your side on how other assets can fit together, or are they more separate and not really supposed to combine the two? Would love your thoughts on this.
No, definitely. I think what Theo is doing is really interesting. I think we're going to need to see more innovation and experimentation around how we can use various real assets, commodities, financial instruments to bake yield into simplified stablecoin products. So we're going to see more of these, I'm sure. I think I just wanted to ask Iggy about obviously he was going on talking about the transparency of the TH Gold there. So are we going to see transparency for these jewelers that are taking out they're leasing the gold? Are you concerned about scaling this? Are we going to run out of jewelers to lend to and things like that?
Yeah, so I mean, we definitely can make a lot of that information available, on our website and Twitter and so forth. The jeweler is that we started with is called Mustafa Jewelers. I think they've been around for 70 years, 50 years, something like that. It's the biggest in Singapore based, so that's a kind of a very safe jurisdiction, and it's the biggest in Southeast Asia. So scalability is another thing you mentioned. So they have about a ton of gold in inventory. So there is, relative to the demand that we see, which is well into the hundreds of millions, let's say in terms of just immediate on-chain demand, right? So this is before we even go to, and the opportunity is big, right? Because we actually, once we establish this as a source of solid on-chain yield, we're also partnering with fintechs and neobanks, which allows us to sort of get our product into the hands of hundreds of thousands of people scalably, as opposed to thousands. We so far across our products, we are in 60 countries and I think 80,000 customers. Some of them, which is a lot for crypto native, but obviously, once you get to the DeFi Mullet business, right, but it's the Web2 interface, but powered by Web3, that can scale a lot more, kind of like the Visa credit card that's backed by stablecoin. That's gaining a lot more users, much more quickly because you don't have to mess around with wallets and of course self-custody. We're all huge believers in that, but for a lot of people it's easier just to have an interface that they're used to.
Yeah,
definitely. So transparency is we'll disclose where we're leasing the gold, and then scalability. So Mustafa, for example, they want to expand across Southeast Asia. They want to expand into other countries that are around Singapore, and that will double their size. And then we're adding other partners where we will lease the gold out. And it's not only jewelers, it's also, for example, refiners. Because right now, for the next 5 to 10 years, there is very little growth in gold mining, because gold has been flat for 12 years prior to the current bull run. So basically, since it had a moment during GFC, and then it did nothing until 22, 23. So people stopped investing, and then even back then, a lot of the money, the gold miners sort of distributed as dividends rather than reinvest. They were kind of more shareholder friendly. So anyway, so gold in the long run grows at 2% a year, but for the next 5 to 10 years, it could be sub 1%. So basically, refiners, sometimes they have shortages of gold and they have gold demand, so they need to lease gold because they're a supply constraint. Like jewelers need to lease gold because there's a massive inventory risk. So that goes without saying. When gold, in one day declined 10%, that could wipe out your margins for the entire year as a jeweler. So you definitely want to stay in the business of manufacturing the jewelry, selling it, not speculating on the gold price. And then we also look at other opportunities. So I mean, that's kind of where a lot of the fun part of my job is. We evaluate other investments, things that are backed even by oil storage, trade finance, other commodity-based lending. So we try to find things that are not traditional private credit, because obviously right now it's extremely opaque, and there's, as kind of a well publicized, it was number one story prior to the war, is that there's a bit of a run on private credit, and maybe again, when you have something that grows that quickly, by necessity you would have a speculative aspect. So we are not too keen to bring private credit on chain because of, first, kind of a quality of assets, likely not so solid, and opaqueness, and number 3 is lack of liquidity, because on-chain capital wants high liquidity. So we sort of in the near term we like this commodity based lending because we can secure it. We can secure the title on something that's sort of fungible and liquid as opposed to some business that's kind of hard to analyze and things can turn on a dime. And also the commodities, we can hedge it in the futures market or OTC market. So we also work not just with futures, but we are onboarding with physical gold, so we can actually have allocated bars and we can move the bars with our broker partners, and we can do OTC. So we have several places where we can, and of course we can trade in multiple venues. So we have multiple ways to de-risk. So if for example the futures curve is doing something weird, we can still do those trades using OTC. So it's diversity of kind of gold partners, and then ultimately having other types of investments in. So we're taking like a look at power and oil, for example, if we can figure out a way to really trust the storage. Oil storage, of course, is much harder than gold, right? It's sort of, especially right now, there's not too much oil in storage. It's sort of quickly being used.
Definitely. I would kind of just add that, to everyone else, we can see how many layers there are to this, like particularly for your product. There's a lot of complexity that's being abstracted away into this stablecoin itself or into the tokenized gold. So as we see more and more innovations across stablecoins and across different types of stablecoins, different types of real world assets coming on chain, there's huge complications and complexities and things that need to go on in the back end. So just as much as Iggy's just talked about what's going on behind TH Gold, the same thing is going to be happening on all these newer stablecoins and newer RWA tokenization. So there's a lot of work going into all of this.
Yeah, I think it's hard to execute because you need to sort of really have sort of deep expertise in both TradFi and on-chain. So there's a lot of people that are like, because at Polygon Ventures, that my team has evaluated over 1,000 projects. I personally, met with like a few hundred. So there's a lot of really strong crypto native teams. In my prior life, there's a lot of strong TradFi people. But there's very few teams that combine both. So like one of the reasons that, I've been an investor for most of my career, and then I became a builder again with Theo, because the founders have actually bridged the gap. So they were quantitative market makers before in futures actually, and a couple other things. And then they built a $1 billion project on chain already. So they had, it's kind of one of those rare teams that had expertise in both TradFi and on chain. And they also had very strong engineering background. So I like to say that you need to have 3 legs in order to build a successful RWA project: TradFi, on chain, and then strong coding and algorithmic skills. So they kind of had all 3, and I think you need to have all that in order to mitigate all the risks, right? Execute properly, like you said.
Awesome. Thank you so much for giving us such a technical breakdown of what gets abstracted behind the hood at Theo. We have a few hundred listeners with us today. I just want to grab one of their questions and kind of take it to the kind of the opposite spectrum of what we've been discussing. So if we were gonna if you were then thinking about it from the perspective of the average user, the average crypto consumer, or just someone who has sort of mildly seen Visa, Stripe, PayPal all launch their own stablecoins. One question which we have from the audience is, how does a stablecoin actually work? What makes them stable, right? We've seen previous instances where certain stablecoins have depegged and things like that. So maybe I think I'll pass this one to Thomas to see where he can share a bit of his expertise. What makes a stablecoin stable? What makes a stablecoin special? What exactly is a stablecoin? I'll pass the mic over to you because you probably answered this question hundreds of times.
Yeah, sure. So obviously stablecoins are stable to whatever they're meant to be stable against. So obviously nothing is really stable necessarily, but typically things are pegged to the US dollar in this world anyway. Most domination is through fiat-backed stablecoins, so they're just backed one-to-one at least, or over-collateralized at least against these against dollars off-chain, essentially, right? Or T-bills that represent those dollars. We have different types of stablecoins across the spectrum. More like decentralized stablecoins work through collateralized debt positions where you kind of have a different kind of asset like a Bitcoin or an ETH and you lend against it to mint stablecoins, okay? But that backing has to be over collateralized. So there's always more backing in the system than the like minted stablecoins themselves. And then you have kind of synthetic stablecoins, which we see probably on the TH Gold or whatever their new stablecoin, where you essentially hold one spot asset. Yeah, so you hold one spot asset of something, and you're generally shorting that asset somewhere else and capturing the yield, both from holding the spot, and maybe that's a yield-bearing spot, and also the funding rate on the short side. So this is obviously how Athena's USDE was mainly built around, and now we're also seeing Theo building something similar, but from a gold point of view rather from a crypto native point of view. Obviously there's many other types of stable coins, and they don't have to be pegged to just USD. We also have Euro stable coins, but they're not that exciting or deep in liquidity or have much yield attached to them. So they haven't been that prominent just yet.
Awesome.
Yes, I think the difference between the stable coins that fell apart is that they were sort of algorithmic or trust me bro methodology. I think that the true stable coins have to be fully backed, right? So or yield coins, right? So like a money market fund is not stable. It will grow value. It's actually a good thing. Backed by U.S. Treasuries or so. TH Gold, TH USD are backed by gold that we retain title to. Gold is very easy to sell, right? It trades. Gold trades 300 billion a day, so there's no issue with like it's sort of being stuck, and you don't have. It's not dependent on some other like fake token, and it could be backed. It could be backed by oil, could be backed by other sort of TradFi assets, and yeah. So there is the basis trade that what we do is you could call it a basis trade, and Athena was also a basis trade on chain, but and the key difference is in our case is backed by gold, which has been around for a while, so Athena was a great success, but the problem is on chain there's limited capacity, right? So they became a victim of their own success, which is they became so big that the yields actually came down. Whereas gold is right. So there are 7 million ounces of gold. Let me think. Yeah, exactly. So there's 35 trillion of gold above the ground, and there is 3 trillion of crypto assets. And in terms of RWAs, there's 300. In terms of gold on chain, there's a few billion. Right, so there's multiple orders of magnitude of kind of a safety cushion in terms of when we run up against the ceiling, or when the yields will actually start to come down. There's a lot more runway because TradFi is still so much bigger than on-chain.
What is the long-term goal for what is the long-term goal for Theo in terms of what will it take to get them into the hands of the average person in terms of the stablecoin? What is the plan of distribution and sort of adoption to the more non-native crypto user? Because I think something that you guys do really, and that's really interesting, is abstracting that experience of everything that's happening behind the hood of where the yield comes from. Are you guys targeting the average user? Are you targeting people who are more looking to grow their balance sheet by having sufficient liquidity? Do you see you guys sort of growing into being a more everyday payment method? Want to kind of understand what is the long-term distribution goal for Theo?
Yeah, so I see 2 questions. One is, do we target the average user? And then second, do we want it to become a payment method? So the second, I would say no, we're not aiming this to become a payment stablecoin, because that would require different kind of partnerships, and so it's slightly different strategy. I think could be in the medium to in the long term. I would say it could be used for payments, especially business to business payments, if they're like larger ticket type payments, but not necessarily like the peer to peer stuff. But average user for sure, because again, it's a sort of a savings and investment tool. So people can sign up directly. There's also secondary markets. Like I said, one of our missions is to make sure that all of our tokens have liquid markets, fair price discovery on chain, that they're composable in DeFi. You can do looping. You can pledge them as collateral. You can borrow against them. So for the crypto native audience, we definitely want to make them accessible to, like, crypto retail, not only crypto whales. And then we definitely want to partner, and we're actually told in the process already, partnering with new banks and fintechs, especially stablecoin based new banks. And new banks are going to stablecoin because of just global dollarization right now. And for a new bank, rather than getting licenses in 200 different countries and dealing with 200 different currencies, they can just launch in stablecoins and be available anywhere right away. So it's just, stablecoin based new banks are going to take share from regular new banks. And then we are partnering with them to provide yield to their holders. So they can do different things within the new bank, like pay and peer to peer and buy things. When for the idle balances, they want to earn yield. And then that's where we come in there. So there we can access mass market that's not necessarily crypto native.
I'll pass the mic over to you, Thomas. What's the most interesting discovery that you guys have found about stablecoins? Is there any recent research pieces that you guys put out that you wanted to share some findings from?
Not quite, I would say. I think we haven't put any recent pieces out about stablecoins. They've been written about so widely, to be honest. We've generally chosen some other topics. We do have something in the works around AI agent payments, especially on Ethereum, where obviously, the sways of AI agents coming online and being able to transact with one another in the future hopefully will be happening on chain. We have standards like X402 online. We haven't seen much growth, to be honest, in the usage just yet. I think it's quite a nascent segment, but we're going to be publishing something soon on that, and I think it's something we expect to see a lot of growth in. However, the growth hasn't been too exciting just yet, but it's definitely going to grow. I think another data point I can share now is that we've obviously seen stablecoin on chain growing really nice and steadily, but the more exciting thing that we're seeing is that stablecoin usage and velocity is growing at a much faster rate. So the stablecoins aren't just sitting on chain anymore doing nothing. They're being used, they're being put in lending markets, they're composing elsewhere, they're being used for payments and transfers and business transactions. So even if we see a slowdown in stablecoin growth for any sort of reason, I think we'll continue to see more velocity of stablecoins or their usage on chain despite that. So expect this to pick up both from a human perspective and also an AI agent perspective.
Very interesting to see where agentic payments go, 6-12 months from now with the speed of how the tech is evolving and how the complexity is getting abstracted away, and of course the popularity of agents and them being used. So we're close to wrapping up, and I want to ask both you guys the same question. It's the same one we ask every single week, which is, what's one thing you want the audience to know that we haven't discussed already? What's something that they should take away, something that's important, or something that's coming soon?
You go first.
Well, interesting indeed. I think, to be honest, one thing that we're most interested in and excited about is HIP-4, when that's going to come out and be released, and what's going to be built from it. So new platforms, new exchanges being built, both from a prediction markets point of view and also an options point of view. So Hopefully, we see some more exciting options-based derivative products being built on top of the Hyperliquid Hypercore order book. But yeah, and obviously, I expect it to be just as powerful and more disruptive than we've seen HIP3, which is obviously capturing headlines everywhere.
I like that one. We're actually also very Hyperliquid aligned and very bullish on Hyperliquid, especially in the already and especially in the coming cycles. So that's a great one. I would say for me, and one of the reasons I joined here is the long-term vision that I see is that anybody in the world can build a proper portfolio, right? Just like I said earlier, to save for retirement, save for college. So I have this fancy private banker that's expensive, and you can do, for example, a structured product. Say, hey, I'm willing to take half of the market return, but I don't want to lose money. Right now, that's very expensive, high minimum, massive paperwork. On chain, you can, because it's money Legos. On chain, you can build this very cheaply with no minimum. So the reason I got excited in the long term and to work in this area for the next 10 years is to make all of these professional investment tools. The greatest wealth creation engine is the US financial market, right? Wall Street. And out of 8 billion people in the world, maybe about 1 billion people that live in a developed world can access it. So right now it's, we deal mostly with non-chain capital, but in the long term, it's all the capital in the world. There is 120 trillion of M2, which is money. M2 is a money supply. 120 trillion around the world. Vast majority of that is sitting in bank accounts earning no interest, right? So people are getting screwed all around the world. So either they have no access at all, or they're not getting fairly compensated for their savings. So this is a 4 or 5 order of magnitude greater opportunity than what we have here in the long run.
Amazing. Thank you guys both for your time. It was a pleasure to have both of you guys on, both very knowledgeable guests, and I hope the audience has been able to learn something and it wasn't too complicated to their current knowledge of stablecoins or RWAs. Thank you guys both for your time. Any final words from either of you?
Thank you for the time. It was a pleasure.
Yes, indeed. Thank you, Abby. Just come and check out Castle Labs, subscribe to our research, and we're dropping a weekly newsletter and multiple long form research every week. So
great. Yeah. So we're also Theo Network on X, and theo.xyz is the website.
Amazing. Thanks, guys, and I hope the audience had a good episode and hope everyone has a great Friday.
nice
Thank
one.
you.
Cheers.